I want to start off with inflation. We're expecting the inflation number to come out today. A Reuters poll of analysts expects it to come to as low as 5.5%. Where do you sit?
I think what we've seen is an easing of the supply side constraints since December last year.
Yes.
And in the process, we've had a lot of gains on the inflationary front. So I think I also see a decline, although I will not quantify my projections, but I think we are still going to see it fall below 6% this month.
The central bank revised its inflation target. It used to be around 9%. It went to 7%. So it's well below that inflation target. Maybe should it be taking it even lower because it looks it's achievable?
It's achievable because what we've seen since actually specifically starting Q2 is, and as I said before, the easing of supply side constraints. And
yes.
This has been on the back of a good harvest. And so good harvest has also seen food prices stabilize since Q2. And also this has been off the back of bounty rains. And then also what we've done is we've also seen global crude prices also come down a bit because a lot of those, a lot of the surge in inflation last year was as a result of transport cost surging. And we know, I mean, energy costs are the bedrock of this economy, so it's a wheel of this economy. So when you have a situation where the energy prices skyrocket, then you'll have seen that a lot of translation of that into the local prices.
I want to touch on that a little because fine, we've got a bountiful harvest, so the food prices, there's no risk too much on that side. But on the other hand, on the energy side of things, we still import fuel, we still import crude. And what kind of a risk do you see there, if indeed there is a risk?
There is a risk because what we, in fact, in our in-house approach is that we are still seeing some substantial risks, especially on the Middle East tensions. And specifically, if we see a flare-up, there's still going to be a flare-up on the Iran-Israel case, and this is the only point that holds a substantial downside on global crude prices.
Right.
And the second bit of this is if the quantitative easing that the Fed began this a few weeks ago, because what we'll see, there's going to be a devaluation of the dollar, a dollar going down, and in the process, crude prices going up. But we've not seen that. In fact, on the contrary, we've seen a lot of pullbacks on crude prices. But again, there's still upside. There's still substantial risks going.
Let's play this to its logical conclusion, which is how the inflation rate leads into the interest rate regime as a whole. The central bank cut the CBR quite steeply, 350 basis points the last time it met. Inflation, or rather the interbank rate has come down, but overall inflation, overall interest rates to the real economy haven't come down as much as we might want. 18% or so is an average, maybe 19% as it is right now.
Yeah, true, and it's good to discuss the efficacy of the monetary policy tool. And
right.
in Kenya specifically, you're talking about CBR. Mm-hmm. There is questions are still abound as to the efficacy of monetary tools, because one, I will tell you that as a banking from the studying banking sector in Middle Africa, it's not yet there 100%. We haven't achieved 100% transmission.
Yes.
Between the monetary, the application of the monetary tools and the subsequent subtraction in the system, it's still not there 100%. Because one, for example, I'll tell you, in Kenya, the pricings are largely dictated by the borrower's risk, and it's two key factors: the borrower's risk and also the cost of funds.
Right.
Because what you're saying is that there is an interbank market where banks go to borrow.
Yes.
And it's largely dictated by liquidity levels. So what you see is that there is they actually bypass CBR to price the funds. So they actually look at interbank, how is the interbank, and how is the liquid in the market. It's a question of
But George, from where I sit, I feel the cost of funds are not as high as banks make us to believe, but our borrower risk is the one that's overstated, and that's why our interest rates are ridiculously high.
No, but you see, you need to look at it. It's not. Look, it is the borrower's risk. Yes. It's there. Mm-hmm. It's there. But again, what is the risk there? the borrow, it's some of this risk. The pricing is all on the risks and the cost of funds. But if you look at it, is it secured or is it unsecured?
Even what we call unsecured loans in Kenya is which the way it works is I will say I'm employed by CNBC Africa. I make this much amount of money. Here is my payslip for the last 3 months. Can you give me a loan on the back of this? So it is secured by my salary because you get into an arrangement with my employer that every time before I'm paid my money, they will deduct this amount of money which I owe you in my repayment. So it's not unsecured per se.
It's unsecured. Let me tell you why. Because if you look at the whole concept of collateral management,
yes,
that if today you defaulted, the bank, what are the options of the bank? They they have no access to your car or your house, so that they can liquidate to recover back.
It's a loss of income. I have lost my income.
Yes. If in case you've lost your income, they have no other refuge, you know. So it's largely unsecured. So what they have is your salary, you know. So when it comes to risks and collateral management, I think the banks they're justified in premiumizing your pricing to that level. So, but I think going back to your question, I think what the central bank did was to actually just tweak the market psychology that, look, hey guys, we are done with tightening. What we are seeing is that the risks are subsiding, so we can be on an easing path a bit. But in the actual pricing, it's either base minus or plus. Actually, in most cases, it's base plus. So what if banks' base lending is at 18%, then probably if they're pricing your risk, then if they're pricing you, then they probably do 300 pips plus 18%. So your actual borrowing cost is actually higher than the base rate. So that's how people need to look at it. But in terms of the transmission mechanism of the policy rates into the system, we still have a lot of ground to cover to achieve 100% transmission.
All right, I want to move into the Nairobi Securities Exchange very briefly. Yesterday we touched a new year high of 3,980, but one of the things I want to pick out, which is what you deal with, is banking. Equity Bank was one of the main drivers of activity yesterday. Why is there so much foreign interest in counters like Equity Bank?
What we've seen is that, and I'll talk from a general point of view.
Yes.
Economies like Kenya, some of the key economies in Africa like Kenya, Nigeria, and I mean that's sub-Saharan Africa, ex-South Africa, Kenya, Nigeria. Those are the most visible markets in this region. What drives this economy? Actually, they are all considered as bank-led economies, where enterprises and individuals go for credit and then plow it back into the economy. So these are all generally credit-led and bank-led economies. So investors, when they're sitting out there, the only sectors that they look at is the banks that lead these economies. You know, banks generally drive these economies. So they want to take up a position in these sectors that drive economy. Top among them being the banks. That's why you see they will continue assigning premiums in the evaluations of these banks. And then also additionally, you look at some of these banks and the leading players in Kenya, like for example KCB and Equity Bank, they're quite resilient.
Right.
There's a lot of resilience in terms of their top line, despite macro and financial fundamentals declining substantially over the last, specifically in Q3, Q4, and Q1 this year. They still have some resilience, and they're still bringing out above threshold, high quality EPS. But investors say, hey, look, these guys are very resilient. Despite the declining macro fundamentals, the EPS is still high quality. So they're still delivering high quality earnings. That's why you see there'll still be a lot of premiums assigned to some of these key players, the banking stocks in the market.
All right, George, thanks for putting that into perspective. Asante sana.